you need to have a plan. You need to have an investment strategy which is based on diversification and a portfolio which is structured around well-defined investment themes. Meaning that what you buy is much more important than when you buy it. Number two, don't get eaten by emotions and by all what you read and see every day in terms of press or news. And number three, don't try to type the market and try really to stick to the big picture, because the big picture over the long term tends to be fine. My name is Wuergler. I work for Julius Bär now for more than 17 years. And I'm currently, for the last 5 years, responsible of the investment advisory team worldwide. To me, a financial crisis is really defined by a very, very strong correction. So we're talking here about 40 to 50% correction. Usual market correction that you could define 10-15%. So a crisis is really when you have a crash on the financial markets. And most of the time, this is quite also quick. It's not about a few years, but it's about probably a few weeks or few months. Over the last 24 years, we had 3 of them. We had in 2000 the dot-com kind of crisis. We had in 2007, 2008 the global financial crisis, what people they do refer with the US subprime crisis. And then 2020 the COVID-19 induced crisis. So we can do the math, but I would say every 10 years you can expect that we may have a major market correction. Diversification is always important. And obviously diversification at the end of the day means we don't put all the eggs in the same basket, meaning that we know that not every investment will perform the same. Most of the time, when you have a financial crisis, everything tends to suffer. So this is where you do expect as a client to get the highest benefit from diversification, and you may be frustrated because it's a financial crisis and everything goes down at the same time. And during normal times where you can expect decent market return, obviously you still have segments of the markets which outperform and others which are going nowhere or are really also suffering a little bit. So diversification anyway, it's a must in my opinion, but it works at best not during a financial crisis, but during, let's say, normal times. Based on my experience, the biggest mistakes that we do is we don't sell at a loss when we need to sell something because things they have changed, meaning that we stick with the losers. And we tend to fall in love with our own rationale about a storyline. And I always say to people, you need to fall in love with people, not with a stock. So the mistakes that I have just mentioned so far are mistakes that they are done at every level of sophistication. And this is for a simple reason. It is because this is emotion-based. Most of the time, people, they don't want to invest into the markets because they believe the markets, they are too expensive. Now, the point here is 90% of the time, the markets, they are expensive. And they get cheap when you have a crisis. And the art would be really to take advantage of any crisis in order to invest into the financial markets. Now, it's difficult to do it because whenever you have a crisis, people, they explain to you why you are having a crisis. So they have to rationalize that. They will scare you by explaining to you what's wrong with the financial markets and why they are correcting. And in my experience, nobody really wants to buy the markets when you have a crisis. Very often you see people saying, the market is wrong. The market is never wrong. It's probably me, individually, who can be wrong. We need, in my opinion, to be humble enough to accept that collectively the wisdom of the market is superior to probably my own analysis, and we really need to listen to what the market tells us.